And again, so there are certain contexts that, again, that I feel that I'm preparing for litigation, and also maybe if I can present a position that shows that type of preparation, maybe I can avoid litigation. And so, for example, when I'm doing an estate tax return, you know, I mean, to me, it just makes sense in almost all cases if you've got a business interest, like a closely held business, that you've got stock, or maybe a limited liability company. I'm going to be sure to get a good appraiser, a qualified appraiser, to prepare a report to include with the tax return, the estate tax return, in that sort of a case. And then another is also gifts. I mean, it's huge area, so
yes.
Anyway, and there's lots of litigation in this area, so you may as well prepare for it, because if you don't, well, you're going to be there anyway. You're just going to have to make the investment.
Well, a well-written appraisal report, well organized with a table of contents at the beginning, supported by empirical analysis and third-party references. It's more than just the appraiser's considered opinion. It's based on research that they've done that applies to the particular case.
Mm-hmm. So we've already sort of gotten into this. Maybe we should go ahead and hit a few areas for which valuation studies are used. So we already talked a little bit about estates and gifts. And so maybe you can talk a little bit about some of the other areas that you get some of these projects for.
Sure. And, well, an estate would be somebody died and they own either a company or an interest in a company. That's a taxable asset, and the IRS wants to know what the value of that asset is for estate tax purposes. When people make gifts, they can make a gift of property, obviously, before they die, and that's a better estate tax outcome to have done that. The value of the gift needs to be appraised. But other reasons would be shareholder disputes, where there are two shareholders that decided to part ways. One's going to buy the other out, but they can't agree on the price.
Yes.
They can go to an independent qualified business appraiser, and the appraiser can be the intermediate, and not taking sides, come up with a value that's accepted by both parties. Mm-hmm. We do it for employee stock ownership plans, where if someone's planning on selling to an employee stock ownership plan, that gets done at the beginning and also every year.
So so you may know them as ESOPs.
Exactly.
Okay, and you can have a situation where you can actually give stock, private company stock, to an ESOP and get a tax deduction. In that case, you have to get that stock valued in order to determine what the tax deduction is going to be.
Exactly right.
Yeah.
Now, divorce is another one. Now, our firm doesn't do divorce work. Others specialize in that. Divorce valuation work is kind of confined to following some recipes laid out in 2 or 3 different California appellate court cases.
Okay, we're in California, so bear in mind it may be a case for your state. Okay, go ahead.
So because of that constraint, what we do, we'll do divorce work if the husband and wife will come to us and engage us as joint clients. Mm-hmm. And then what they'll do, we don't use the divorce methods that are required by the courts. We use the broadest financial application of valuation techniques that we can. And then the husband and wife go into court and stipulate they've had outside help, they've agreed on a value for the business, and they don't have to litigate it in court. Mm-hmm. And then financial reporting is a big one.
And that's a fairly new area, this fair value accounting and so forth.
It is. And they use that term fair value instead of fair market value. And it's debatable about how wide the differences are between the two. Mm-hmm. But the Financial Accounting Standards Board is the body that sets accounting standards. And they've required that, as opposed to the way accounting used to be done, which was most assets were put on a balance sheet at their cost.
Yes.
And then sometimes depreciated. And now what the Financial Accounting Standards Board wants people to do is to put assets on their balance sheet at its fair value. Mm-hmm. You could say almost at its fair market value, but they confine it to a specific definition. Mm-hmm. So now when one company buys another, they're required to identify previously unidentified intangible assets and put them on the balance sheet. Patents, trademarks, trade names, the value of a customer base and a customer list, in-process research and development, recipes, trade secrets, all of those kind of things can be valued and need to go on the balance sheet these days.
So folks, I think you can gather from what we're saying that these people are becoming very busy because of all these developments. Okay, we're about halfway through, in case you're wondering where we are. What is the process for conducting a business valuation study?
Well, and the study is a good term for it. It's an economic study on the value of a business, and it involves a thorough understanding of what does the business do, who are its competitors, how does the economic conditions in place as of the valuation date impact the value of the company. For example, if you were a building contractor and you valued the company today, they probably don't have a very big backlog of new business.
Yes.
Whereas several years ago they might. That impacts its value. And then we consider the earning power of the company, its historical and its projected earning power. And the question is, if the company is valued on its earning power, which earning power do we use? Last year, the last 5 years, the average of the last 5 years? How do we do that? And the answer is it depends on the facts and circumstances of the case. So we have to evaluate all of those things, and then we compare the company to sale transactions in a similar line of business and see what those companies have sold for, and we compare the price at which it sold to its earnings. When you look at the value of a house, if I were to say, well, a house sold last week for $800,000 in San Jose, is that a good deal or a bad deal? You wouldn't know unless I described the neighborhood and the size of the house. For a business, we describe its attributes in terms of its financial characteristics. So we study all of those things, and we even look at publicly traded companies because we can get value for those easily over the internet. And although we need to make adjustments to those because we don't apply unadjusted public company multiples to a private company.
Okay. So why would someone need a business valuation specialist who doesn't actually have a business? So I don't have a business, but I might need a business valuation specialist. What sort of a scenario can you come up with where I might need one?
Sure. Well, often estate planning lawyers and tax accountants help people do planning by taking real estate and put it inside an entity, like a limited partnership or a limited liability company, an LLC. And now, with that real estate inside an entity, what they do is they give away an interest in the entity itself. Well, now you're not giving away real estate, you're giving away an intangible, which is an ownership interest in a company. So in that case, you're not owning an operating business, but you have an entity that owns real estate, and a business appraiser are the people who specialize in that.
Okay. Can you distinguish the valuation approach that's used by a business broker compared to a report by a business valuation specialist?
Sure. The appraiser is independent, not taking either side, and makes a decision based on rational economic behavior. A business broker is an advocate for the seller. They're in a different position. Their job is to get the maximum value for the seller. So they might bias the information that they tell the buyer, and it's up to the buyer to decide whether they believe that information. An appraiser would show both sides of the story. So I would not necessarily look for a business appraiser if you're going to sell your company. What you want there is someone who's an advocate for your side and can be. Appraisers can do that, but not always.
So maybe we can go ahead and follow up with this other question that I have, and that is, why are companies sometimes bought and sold for values that are widely different from an amount determined based on a valuation study?